Hello there and welcome to Finex Insights. Here, we turn complex data into clarity through stories. Today's story is about a market event that reminds us to look beyond the headlines. Imagine a company whose market performance is breaking historic records, yet its internal financial health is flashing warning signs. This is the Clydestone Paradox, a tale of a company that became a market darling and a financial worry at the exact same time. So, let's break down the data to see exactly how these two realities existed at the same time. "2025 appeared to be a golden year for Clydestone. Clydestone did not simply grow. It skyrocketed. On Ghana Stock Exchange, they emerged as the best performing company. Let's look at some numbers that show this. Between January and December 2025, Clydestone's stock price surged by an incredible 1,433%. To put that figure into perspective, a modest investment of 10,000 Ghana cedis at the start of the year would have ballooned to over 143,000 by December. Now, you might be wondering, what fueled this extraordinary rise for Clydestone? We will look at 4 specific factors that drove investor interest in Clydestone. First on our list is the African Fintech wave. Investors across the continent were hungry for technology exposure, and many were searching for a local hero to put their money into. The numbers prove their excitement. According to data from Tech Cabal Insights, in just the first half of 2025, African fintechs pulled in nearly $640 million. To put that in perspective, that's almost half of all regional funding going into a single sector. But riding the wave wasn't just about timing. It was also about scarcity value. You see, the Ghana Stock Exchange has always been dominated by banks, the likes of GCB and EcoBank. Investors love to invest in the banks because they represent stability, that is, consistent earnings and reliable dividends that you can set your watch by. But with the fintech hype we just described, investors began searching for something new, a promising fintech company that could ride the digital wave. And there sat Clydestone. It was the only fintech company listed on the Ghana Stock Exchange. It offered something the banks couldn't, the chance to own a piece of the digital future. So with only a few tech options available, capital indeed concentrated on the single visible target, Clydestone. The third catalyst driving investor interest was Clydestone's explosive revenue and rapid expansion. The company's hero status was deemed justified by their internal performance in 2025. First of all, revenue climbed by a massive 94%, reaching approximately 23 million cedis. Clydestone also expanded their physical footprint. They pushed their reach far beyond Accra, establishing operations in the key regional capitals like Kumasi, Takoradi, and Tamale. Support these new territories and to fuel further innovation, the company also hired aggressively, that is, bringing in fresh talent to scale their operations and to meet rising demand for their services. Clydestone indeed looked like a company in hyper-growth mode, a fintech giant scaling exactly the way investors wanted to see. Finally, context, as they say, is everything. The year 2025 saw a dramatic shift in Ghana's economic climate. First, inflation crashed from a painful 23.5% in January down to a cool 5.4% in December. At the same time, the total stock market index saw a 79% return. Now, note that this return was the highest jump the country had seen since 2004. Finally, the cedi also grew 40% stronger against the dollar. All these factors combined showed that the entire economy was booming, and investors were hungry for risk. For Clydestone, this meant they weren't just a tech hero. They were the right company in the right sector at the absolute best time. However, when you peel back the layers of this success, a more complex reality emerges. A paradox. While the stock price was up over 1,400% and revenue was also up, the company's financial statements told a different story. Net profit actually plummeted by 53%. But how does a company increase its revenue but decrease its profit? The answer is debt. To fund the aggressive expansion across the country, Clydestone's finance cost jumped by 178%. So yes, they were growing fast, but they were borrowing expensively to do it. Now, this divergence between stock price and financial health created two types of investors. On one hand, you have the optimist. This investor sees a sustainable giant. They focus on the 23 million cedis in revenue and the company's market dominance. They are betting on potential, that is, viewing the current debt as a necessary fuel for future growth. On the other hand, you have the skeptic. They suspect that this growth is merely an exit strategy, and the company's goal is to pump up revenue to attract a buyer for a quick acquisition, rather than to build a business that can last. The skeptics flag the 53% drop in profit and the soaring debt as critical dangers. In one market observer's words, Clydestone is a pig being fattened for the slaughterhouse. As we close the book on Clydestone Story, we are left with a billion-dollar question. How do you distinguish between a company building a sustainable future and one that is just riding a short-term hype? We'd love to hear your responses, so do leave them in the comment section below. This has been a Finex Insights Data Story. Thank you for sticking till the end. Don't forget to like this video, comment, and subscribe. See you in our next one.